Hello, everyone. This is Terry with Futures.io, and as always, I'd like to thank you for joining us today. It's my pleasure to welcome back Chris Gray from Earn2Trade for today's webinar, Getting Comfortable with Price Action Patterns. Throughout the webinar, if you have a question, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Chris, and you will get the pop-up to share your screen again.
Wonderful. All right.
All right, looking good. She's all yours.
Very well. Thank you very much. Greetings, everybody. Thank you for joining me as always, and thank you, Terry, for the introduction as well. We are going to be diving into something called price action today, and this is something that is obviously going to be geared a little bit more towards those of you that are technically, you're TA-based traders if you're attending today, obviously, because you're interested in finding out those patterns that are reoccurring throughout history in regards to where price has been and how it responded when it was at this area before. And as such, we're going to give ourselves an idea of how we can look at this type of event in the future. Now, this is definitely going to be something that may be geared a little bit more towards some of my newer TA traders. And when I'm doing these, it's always, my goal to bring something interesting to you guys, but I understand that I can't always cover every aspect of the trader spectrum. And this is something that I had a lot of requests for, so I am quite excited to bring this to you guys. But without further ado, let's dive on into it. And at the very end, like Terry said, if you have any questions for me, I'd be more than happy to answer them and try to, clarify as much as I possibly can with you. So diving on into it, the first thing that we want to do is, give a proper, introduction into who I am, so you have a reason to pay attention, I suppose, or maybe even an interest to, kind of go a little bit further. But what we are is a company called Earn2Trade, and we are essentially a proprietary trading firm. I'm sure you've heard of them in your time once or twice if you've been around the block. But the idea is simple. If you have the skill sets, we want you to trade our money. Pretty simple idea. It's appealing because it gives you the opportunity to prove your skills without risking your own capital. And if you have the skills, it's a mutually beneficial relationship because you're trading, you're happy because you're not risking your own money. And if you're doing well, then guess what? We're happy because we're taking a small percentage of it. And that small percentage is by far and away, at least at Earn2Trade, we do give the vast majority, over 80%, to the trader itself. So don't think that it's some weird, devil in the details type situation. But I encourage you to check us out. But we have a few different options at Earn2Trade, and our history kind of dates back to 2016 when we really started going, because we saw a lot of different companies out there doing it, but not really seeming to value that mutually beneficial relationship. Instead, it seemed to be more or less trying to steal from the traders and take advantage of their knowledge and just take advantage of the fact that you have capital. Instead, we wanted to provide an outlet that allowed traders to become profitable even if they hadn't been already, which is once again where all of our education comes in. A huge portion of Earn2Trade is based around education, which is why we love sites like Futures.io and other educationally based sites. But we were founded in 2016 with this guy over here on the left, Ryan Maston. What a beautiful dude there he is, and Francis. And essentially between the two of them, they got us going. We have Ryan, who is our registered CTA, as well as I kind of didn't throw myself into the mix here, but I've got my all of my series exams as well. But we work with 20 plus colleagues throughout the United States, and that's that's a bunch of fun financial gibberish. That the point is, we have our certifications. If you're ever interested, once again, all you have to do is ask or come over. We have them listed on the site, but we have been around for quite some time. Francis is our head of the educational development. He's the one that you're going to be gaining all of your education through if you are interested. He has a pretty extensive background in education with 5 years in economy and society research at Budapest and at the University of Hungary, and 4 years in educational content over there as well. He studied in Japan. But we have a pretty good team helping us get going. And what we have over here is the Gauntlet Mini the boot camp, the gauntlet, and the beginner crash course. Now, these are the the bread and butter, and what we have that's really exciting. And this is the kind of stuff that that is definitely worth paying attention to if you're interested in trading with money that isn't yours and making money with a larger percentage of that earnings being reflective of a larger account. This is the way to go about it. The Gauntlet Mini is going to be an intraday futures trading exam that guarantees funding for obviously a live account of the size that you choose before going into it. It starts as low as $25,000 and works its way as high as a $150,000 account if that's what you're interested in trading. But it's a pretty awesome opportunity with a monthly subscription to be able to obviously maintain and pass the Gauntlet course. It's very, very neat. We also have the Gauntlet, which is going to be the old school. It's a custom developed futures trading evaluation that guarantees a funding for a live account. And it can be purchased for a one-time payment of $429 and then lasts for a fixed period of 60 calendar days. But there's a lot of good stuff going on there. Didn't mean to switch off of that. But the boot camp is where I come in myself. I'm an educational presenter, mentor, trader, all that good stuff here at Earn2Trade. And if you do the boot camp, if you do the beginner crash course, that's where you're going to get the one-on-one mentoring. We're going to go over whatever it is your strategy is. We're going to break it down systematically, and we're going to build whatever it is into something profitable, something that you feel that you mesh with. And it's my goal to be your personal trainer in that regard, to find out, give you a bird's eye view of what might be working, what might not be working, systematically break down the results and see how we can improve 1% here, 2% here, 3% there, and get ourselves over the edge. But anyway, that's the stuff that we've got going on, and that's where I come from. Just wanted to give that as a brief little, more or less introduction to where I'm coming from myself, because, regardless of, the educational material that follows, obviously, I want you guys to have a way, if you do enjoy this, to be able to come back to us and find a way to ask more questions or get more involved with us. So, but without further ado, let's switch on over into our educational material. And that is going to start with what is price action. And price action brings together an interesting mix of information and different views. And I am not going to just simply read off of PowerPoint. So before you think that, don't worry. This is going to be a little bit more fun and casual than that. Now, this includes historic price patterns, technical indicators, and the trader's ability to read the market. There are numerous types of trading strategies, and many of which depend on technical analysis or an individual investor's opinion. Price action trading, which is what we're talking about today, incorporates both of these strategies, the technical analysis side to identify maybe support resistance levels, as well as investor opinions, which can obviously vary greatly. But the idea is, we're going to look at what price action is when it historically is repeating itself, these certain patterns. We're looking at the price action patterns today, and we're going to highlight quite a few of them. I think I have somewhere around 13 or 14 of them here for you today, and we're going to go over to the charts as well, live charts, and have a little bit of fun and see if we can find some of those. But the concept behind price action is to take in those short-term fluctuations as well as pay attention to the emerging trends. And then we're looking to focus on the patterns that are repeated time and time again. The idea is, if we have an expectation that, say, a Head and Shoulders, which we will be covering in just a moment, has an expectation of giving a specific result, say 64% of the time throughout a sample size that spans back maybe 2-3 years on an hourly chart or what have you, on whatever asset, doesn't matter, you guys get the idea. The point is, if we have an expectation of those results, we're using that information as a reason to expect a forward action. So it's kind of like the self-fulfilling prophecy of what really a lot of technical analysis-based trading comes down to, because there is a large psychological factor in the market, amongst many other things. But because people are aware of some of these most common patterns that we're going to be going over, when they see them, it tends to elicit a specific response. It may be to buy, it may be to sell, but whatever that response is, it's something that people are told is going to happen. So they buy in expectation of the market to go up, in the expectation that other people will buy. But what ends up happening? If you have a large portion of people buying because they expect the market to rise, they in turn are the ones that are now causing the market to rise. So you get this weird self-fulfilling, rolling snowball. And that is one of the core concepts of why price action has been around forever and is something that will continue to be around forever. It's a beautiful little fun psychology twist there. But as we move along, this is what we're looking at. So these are some of the patterns. And let me actually go ahead and it looks like my annotation tool has died on you. So let me go ahead and throw that up real quick. Oh, wonderful. There we go. All right. So now that I have a beautiful drawing tool, you guys can see how terrible my drawing skills are, we can analyze the head and shoulders. Now this is the first one we're going to analyze, as well as my favorite of all. I'm a huge head and shoulders trader. I have been for a very long time. It does get a little bit more complicated than just the simple 1, 2, 3 as what you're seeing on screen. But with this simple 1, 2, and 3, we can analyze a specific trend that has historically happened in price and elicited a result far more often than it has not elicited a result. And what that result is when the neckline is broken, we are anticipating a move in the direction of the break of the neckline. So let me put that in even more simple terms. With a regular head and shoulders, okay, if we're going to call it a bullish head and shoulders, we're calling it a pattern that is going to be a reversal scenario in the market. So if you have a bullish head and shoulders, your end outcome is going to be expecting some type of bullish momentum. If we were to flip this image completely upside down, then we would have a bearish head and shoulders, and our end outcome would be expect the market to go down. But that's not what we're looking at. So all we need is price to fall. That's simple enough, right? And once price falls, there's going to be a period where price looks for support. And when it looks for support, it's going to find a little bit of support that's going to cause it to temporarily retrace a portion of the large move downward before the support was built. So number 1 represents that first area of support. At this point, we don't really know that we have a head and shoulders forming yet, so don't overly, don't let your brain fry and say, well, how would you know at this point? The truth is we don't know at this point, and we don't care because we're not trading at this point. So with the 1, we find ourselves a little bit of support. We work our way up where we then encounter resistance. This is when it starts getting interesting. So because we've worked our way up from 1 to an area of resistance, this resistance area is expected to shut the market down and to cause the market to go push new lows in relation to what has become our shoulder. So the 1 represents the first shoulder. Now, once we run into resistance, we're getting ourselves a nice little push that continues us on with the overall trend. And as we move down and set ourselves a low that's lower than the first shoulder there, we go down and find another area of support that's a tad lower, okay, a tad lower than our shoulder. This is going to represent the head. Number 2 is the head. So we have our shoulder and we have our head. At this point, when we find support at a lower area than the first area of support, giving us the possibility of a head and shoulders formation, this is when we want to start paying attention a little bit more. But once again, we're still not fully committed to trading anything yet because we still need a lot more to happen. So we're going to watch price, and if price gets stuck at the same area that the initial shoulder pushed us to, this is when we're now going to quantify this as a neck. We're going to call this the neck of the head and shoulders. The head is going to be our number 2. The shoulder is going to be our 1 and our 3. So when we run into this neck again, we expect to find resistance yet again. But in this situation, now that we're running into it for a second time, we don't expect the market to have the same strength that allowed it to set a new low. And instead, we're looking for a low that is more comparable to our first low, our first shoulder. So when we get that situation, we get a nice little push down here, and we have our second area of support built right around the area of the first. We have now completed a pattern to a degree. Now we have a shoulder, we have a head, and we have another shoulder. So we have a head and shoulders, S with plural, because we have 2 shoulders. We're a complete body, but we're not entering into the market just yet. There is one more thing to happen here, and this is it. When we return back to the neckline, the moment that we break the neckline, this is the moment that in this situation, I personally will be looking for my long opportunities. Now, the long opportunities of which I'm looking for are going to be dependent on how long the drop was before it created the neckline. So if we had a long drop, say this represents 50 points, okay? And I do know my handwriting's terrible, I apologize. So say the drop to create this neckline and this head and shoulders pattern was 50 points basically straight down, meaning we didn't have a whole lot of accumulation or distribution along the way. The market just dumped. It just cruised on down, little to no support along the way, and that's more or less our steep fall off. If we have a steep fall off of 50 points, my expectation is going to be looking towards the last area of significance, which is going to be based around whatever area of support or resistance we had in the most simplistic sense. Obviously, we can get a lot more complicated than this, but we're trying to keep it nice and easy right now. But a logical area to look for our take profit location would be just under the last area of support that the market had before it initiated that drop down to the neckline, which means if there's 50 points over here free and clear, then I can logically look for a 50-point move over here free and clear. The idea behind the head and shoulders is it's a symmetrical pattern. What's happening on the left side is something that we're expecting to happen on the right side. And historically, when you go back and you look at all of these patterns, that is what has happened more often than not. And because it's happened more often than not, the ability of us to be aware of this is in fact an edge. This gives us an edge over others in the market who are not aware of this, because it gives us an edge of what to expect, and knowing what to expect in the market, or at least having a 60% to or 70% or whatever it may be, a 60% edge over what's going to happen in the market is a massive edge that can be incredibly profitable. We all know that with proper money management, we could actually be wrong more than we're right and still profit with correct money management. You know, if we're always taking trades where we're risking 3 to 1, then obviously we don't need to be 50% accurate. We can be less and still make money. Now, once again, we are only analyzing patterns today that are above 50%, so we don't even need to worry about that. So the concept here is even things that are taken at a 1-to-1 ratio, historically speaking, if the numbers going forward hold as they have in the past, we've gotten ourselves a nice little situation to take advantage of. And once again, head and shoulders do happen quite frequently, but it isn't obviously going to be your only method of entry into the market. It shouldn't be. You should use other analysis on top of it, along with all these other patterns. But the ability of it to create profit in and of itself is what makes it so exciting. Okay, so let's move along here. Now we have the double bottom. The double bottom is a relatively simple one and a relatively easy one to pay attention to, because we're simply going to drop down. We're coming off of a bearish market where we're going to drop down and create 2 areas of support. What does that mean? It means we're coming down, then the market's going to reverse, go up, find resistance, and then come down to an area that is right around the same area as the number 1. So that means our support is being tested twice on 2 different market moves. And if it holds twice, that means we hold once, we hold twice, and we continue to work our way up. At this point, this is an indication that there are buyers here that are unwilling to let the market go down. That's the story that's being told right now. So what does that mean to us? That means that when we gain enough strength that not only are the buyers holding the market, but the buyers are then actually pushing the market, which would be when we break the resistance line, then we're looking to trigger. We're looking to jump in at this point. So the first statement, the statement of the double bottom, tells us that there are buyers down here with a strong willingness to stop the market from falling. It also tells us that the sellers aren't willing to continue selling around this area. Any way that you want to look at it, the idea is that we're seeing a wall, we're seeing a limitation in the bearish pressure. And that in and of itself is good, but it's not good enough to get in by itself, which is why we're waiting for this area of resistance to break. We're waiting for the area of resistance to break, which means in my book, and I should have said this on the other one, but if you're paying attention, we're waiting for a candle to close above the area of resistance. Okay, so a candle to close above. That's my definition personally. You may see this, you may hear someone tell you something different, but that is what has treated me well. It is what has treated a lot of my traders well. And it's a simple way to make sure that you're not getting caught off guard by a temporary blip by some long wick, and then the market sucks back underneath, forms some weird bearish pin bar, and then the market dumps. In order to avoid this situation entirely, we can just simply wait for a candle to actually close just above and then look for our opportunity to ride that bearish momentum higher. The way that we're trading the double bottom is going to be quite similar to the head and shoulders. And a lot of these price action patterns, the way that we trade them will be actually relatively similar in terms of their signs of bullish momentum or bearish momentum switching, as well as a key point in the pattern. So the 1 and the 2 in this case is representing the bullish momentum switching, and then we're getting a key point in the pattern when we're saying that at this point, not only has the bullish momentum kind of stalemated the bearish momentum, but also at this point, we're now saying that the bulls are jumping in at a large enough rate that we're just going to expect and witness the market rise instead of just simply stagnate, if I can talk, stagnate and move sideways in a range-bound market or something along those lines. So concept there, quite easy. The triple bottom, don't have to spend too much time on just because it is quite literally very similar to the double. We're just getting a third bottom along the way. That is literally the only difference. And both the triple and the double bottom happen extremely frequently. Both of these happen more often than the head and shoulders pattern, so they are definitely worth being aware of, and they're not all that difficult to spot. If you see the market falling and then all of a sudden an area of support has arisen, which is pretty easy to see because the market's going down and now the market's going up, if it comes down to around that area again, bounces yet again and gets stuck at the same area of resistance, and then bounces yet again, and then finally after this situation we have 1, 2, and 3. We have 3 bottoms. What do you think we're waiting for at this point? We're waiting for something to give, and generally speaking, that something to give after a triple bottom usually is going to be up here, at least historically speaking, which means we're generally expecting a long opportunity right off of the resistance break. But technical analysis would also tell you that when you get stuck into a range like this, it looks a bit like a rectangle, right? We have an idea that if the market breaks either side of this, we have that built up pressure that should accelerate us in either direction. So the concept behind looking in for the long here, even though we expect it to break to the top side when we see the double bottom, doesn't mean that we can't potentially find a short opportunity off of this, and this is just kind of branching off into a bit more of a flag formation or a rectangle, but we'll get into that in a moment. But moving along, then we have the rounded bottom, and this is a little bit harder to spot for those of you that are newer. This is definitely a little bit of a trickier pattern. It's easy when you look at it the way I have it marked off. When you draw a nice round curve around the location of price, it usually becomes clear. But in the moment, if we were to not have that dotted line or my black line that I drew, then it becomes a little bit trickier to pay attention to this, which is why I'm a big fan of always using your drawing tools on whatever platform you're using. Doesn't matter, as long as you have something that you can draw on your screen with to some degree, basically even just like an annotation tool like I have here, it can bring things to light that you may not be aware of. And this simple fact of the price in this situation has changed ever so slowly from getting new lows to now the lows are progressively becoming higher lows, and also the highs are progressively becoming higher as well. The highs were initially getting lower, the lows were initially getting lower, and then we had this slow progressive switch which created this slightly rounding shape. Well, when it quacks like a duck and it looks like a duck, chances are it is a duck. That's what we've got going on here. What is happening? Price is slowly transitioning from bearish pressure to bullish pressure. Well, okay, what does that mean we want to do with it? Well, if we're seeing this transition, usually this means that we're going to be looking for an opportunity to buy. Now, when we're looking for that opportunity to buy, it's going to be symbolic of this first hill. The first hill that we created, the first area of resistance that we created as we generated this rounding bottom is going to be, if we draw a straight line across, that's going to be our key moment. When we break above this first area of resistance with this rounding body formation, just like the double bottom and the triple bottom, that is the key defining moment. The pattern is letting us know that there is a shift occurring between that mutual war of buying and selling. But this key moment is letting us know that the dam has broken. The proverbial dam has broken, and all that pressure that allowed the market to not just stop, but actually begin working its way upwards, all that pressure has finally broken through a key point, and traders are going to see this. And because of this, traders will most likely want to buy. And what happens when people want to buy? What happens when everybody wants to buy? The market goes up. Right? It doesn't have to be that complicated, and sometimes this is all it takes. The more complicated the strategy, it doesn't necessarily equate to being more successful by any means. In a lot of ways, I think that it's generally counterintuitive to most traders. But moving along, we have a very fun one, which is called the bullish island reversal, that I also wanted to share with you guys. This one is much more rare. However, it is something that historically does produce a more likely than not outcome, and as such, it's a valuable piece of information to give you guys. So here we go. Now, the bullish island reversal is quite similar to the rounded bottom in shape, except it doesn't have to necessarily have such a smooth curve to it. It can seem more at first like a sideways moving market or range, but the key is the gaps. We have a gap on the left and we have a gap on the right. The reason this happens is as the market is falling, what we want is a sudden increase in the selling pressure, a sudden increase that increases so much that the market actually gaps down. There's a fast price movement. It gaps down. We've all seen gaps before. The market gaps down, so we have a broken period in price. That's a strong increase in the selling pressure. What this portion of the market represents is the stabilization of price. And what this second gap represents is the equal and opposite effect of what got us in here to get us out. So as we work our way back upwards after the market has stabilized, what we're looking for is a second gap. And the reason we're looking for the second gap is the second gap indicates that there's a very strong amount of bullish pressure that's all of a sudden being entered to correct the market, because the market spiked. The market spiked downwards over here on the left. And people are saying that, hey, we're in agreement that this is too low. And right now, the market is really, it's undervalued. And because of that reason, we have a ton of people that are ready to buy it because it's a good price. It's low. It's very low. And they don't expect it to stay low any longer. So you get this sudden surge of people buying, which creates the second gap. And with the second gap, you now have this section of price that is off on an island by itself, which hence the name bullish island reversal. This is a bullish island reversal because the end result is to look for price to go upwards. But if we flip this upside down, you absolutely can have a bearish island reversal as well. But once again, concept here, look for the opportunity in once that second gap has happened. Once the second gap has happened, as soon as we can get in for a reasonable price using all other price action to help confirm that we're getting a reasonable price at the time of our entry, we have all of this entire pattern to the left that we already drew over backing our logic for why we're looking to buy. That's the concept there. So moving along, now we have the bullish rectangle. The bullish rectangle is something that is going to be a relatively simple pattern to spot because it's going to occur when the market isn't going up and it's not going down. It's when the market is bouncing back and forth between an area of support and an area of resistance. That means that we generally have a tighter area. It's not a usually it's not exhibited as a very wide rectangle. Most rectangles are going to be a smaller range. And a lot of times this occurs during periods where the volume has dropped off and there's not enough volume to break the trend one way or the other. There's not enough volume to break the support and get the market lower, and there's not enough volume to break the resistance and get the market higher. Now, as far as the bullish rectangle goes, whichever way it breaks, usually we want to favor the direction as well as favor the trade if it is breaking in the direction of the pre-existing move. So that means if we were bullish coming in, the market was rising on the way in before it began traveling sideways. If we were bullish coming in, we would strongly prefer a bullish break. That means we're going with the overall trend, and all of us have heard the old adage, the trend is your friend. And if we keep the overall trend on our side, and top of the fact that we're seeing a short-term price action pattern that is supporting a long decision, on top of the long-term decision, if the trend is overall up, that supports our decision, we already have two things going for us. And we want as many things going for us as possible as traders because Lord knows it's very easy for things to go against us, and the idea is to simplify things and do things with as many reasons in support of what we're doing than, as many reasons as absolutely possible. We don't want to just be entering the market because we're saying, oh, This felt good. We looked good. I don't really know why it looked good. Something in my gut tells me that it looks good, so I'm taking it. All of us are guilty of doing that. All of us have taken trades, whether it's from FOMO or what. All of us have taken trades where we did that. But if we just stick to simple things and we make sure that we always have at least two logical reasons before we get in, two logical reasons, two unrelated logical reasons that substantiate the same directional cause that we want to, enforce upon the market, then usually we're going to be doing a little bit better off than those gut reaction trades. Obviously they can win, but not always the case. Now, the bullish wedge, another pattern that occurs very frequently in the market. The bullish wedge, the bullish flag, I do think I have a flag in here for you guys as well. But the bullish wedge, okay, so what we're going to get with the bullish wedge is we're going to get a bullish market initially. Now, we can obviously have a bearish version, just like all of these other patterns, but we're going to expect price to be rising and then encountering resistance, which causes it to fall and then encounter support. This point right here doesn't give us the wedge just yet. We need to ping pong off of this area of support two more times, once on the resistance, once on the support, before we're going to classify it as the wedge. So after we find support, we're looking to rise back up, encounter resistance. Now here's a key moment. When we encounter resistance, it must be lower than the initial resistance that we encountered. In this case, it is. Then as we work our way back down, we're looking to encounter an area of support. Now, in this scenario, we generally want to see the wedge tightening itself down, which could lead us to two possible outcomes. We could see support actually end up a little bit lower than the initial support, and that's okay. We can still expect the same outcome, or we can see the support actually get a little bit higher. But the idea is we usually want support to be getting a little bit lower consecutively with resistance getting lower, but we want it to converge in on itself. That means that our area of our support and our resistance, the distance apart, okay, between the crest and the trough of the wave here, needs to be progressively getting tighter. That's the main thing that we're focusing on with the wedge. That means if this distance between the first area of support and resistance represents 20 points, then this next resistance, maybe it should be 18 or 16 or anything under 20 points, and we're headed in the right direction. And that means the next one should be even less than that. So we should be consecutively getting smaller between our areas of resistance and support, which is what gives us that wedge formation, just like we were putting a wedge under a doorstop or something along those lines. Now, once again, the goal with this one is very similar to a lot of the other patterns that we're talking about, in the sense that whichever direction we were traveling before we began creating the pattern is the direction that we want to favor and the direction that we're looking for to fully and correctly complete the bullish wedge. So if we break resistance at the top side, that would agree with the overall bullish trend that set us right before we started creating the bullish wedge formation. And we can look for an opportunity to go long at this point when we break and close above the area of resistance. And the expectation is, or the logic is, that because the market was traveling in a bullish manner before we found a temporary stalemate in progress, this could be the market hunting for value. And when we break the trend of the resistance getting consecutively lower and lower, when we land above this, when we close above this, this is a break in the trend of that tightening of this. And so remember, if we were at 20 points on the first distance, the spread between the support and resistance, and then we were at 18 points over here, and then over here, we broke through without creating resistance. So this maybe represents, say, I don't know, 21 points. That is a break in the trend of the tightening of the resistance, which is an indication in turn of an increase in the bullish momentum. So that's the logic and the science behind that one. So once again, we're just looking for a break of the resistance overhead, and we're looking to enter in at that point. So once again, pretty simple concept there, not too complicated. And then we have the ascending triangle. The ascending triangle is going to look somewhat like a bullish wedge, but it's going to have a flat top. So with the ascending triangle, we have bullish price coming in. Then we have resistance. After resistance, we're going to notice another hit of resistance around the same price. So 1 and 2. 1 and 2 are going to be around the same price. We want to have a flat line of resistance across the top. Now our support is going to be progressively getting higher and putting the squeeze on the triangle. And at some point, the triangle's got to break, because otherwise these lines are going to run into each other. And when they run into each other, there's only so much space. The market has to explode. It's got to explode before this point. It is not possible, obviously, for the market to not explode before that point, because that just it has to. It's going to run out of space, right? And when it explodes, it is telling us the same story as what we were talking about with our wedge. It's an increase in the buying pressure if it's breaking through the top side. If it's breaking through the bottom side, we want to be on the lookout for some bearish pressure. But the one that we're interested in trading is absolutely the bullish variation in the situation where price was rising before the ascending triangle was created. So we're looking for the bullish breakout, and that is a close above resistance. Then we're looking to go long in that scenario. Then as we move along, we've got the bullish flag. Bullish flag is going to be a range that is sloped downwards. So that means our highs and our lows are maintaining the same deviations along the way downward. Same deviations along the way downward to create the flag. Now with the flag, there is a portion that is called the flag pole, which is usually a sharp rise or a sharp fall, if we're looking at a bearish flag, a sharp rise into the flag formation. So we want a sharp move, a more or less up and down move to generate the flagpole, to hence give it the name flagpole. How often do you see a curvy flagpole? That's weird. We don't do that. So we're looking for a sharp rise on the way in. Then we're looking for a stagnation in price where temporarily the sellers have halted the buyers and we're temporarily slipping backwards. But when it slips backwards enough and the overall momentum is so bullish, what we generally see in the scenario is that the bulls are going to break out this trend, this occurrence that keeps happening over and over again. And when they do break out, that is the time when we're looking to go long and take advantage of that momentum. And moving along. Now we've got one of the age-old patterns called the cup and handle. Now, this one, I figured I would introduce all of you to, just because it is a very, it's a very nuanced pattern, but I wanted to make sure I introduced it just for the sake of diversity. The cup and handle is a pattern that has been around for a while, does have data behind it. So if you are good at identifying cup and handles, you statistically should be able to find ways to do what you need to do with it. But this is a very tricky pattern for traders to find, because what you're looking for is basically a rounded bottom when the market was working its way up to begin with to generate this cup. So you're looking for a rounded bottom, a slow transition where the highs continuously get lower to a point where then they begin getting higher instead of lower, and the lows continuously get lower to a point where then they begin getting higher instead of lower. And after that, after we have the highs, and the lows progressively working higher, we need one final area of resistance, which creates a temporary downturn, maybe a couple, a couple waves downwards or so, to where we're going to find support and then break upwards. I'm sure you're already understanding why this is going or can imagine why this would be a lot more difficult to find than a lot of the other patterns. And because it is more difficult to find, I do not feel that this is newcomer friendly. And in a lot of ways, this is a pattern that in some ways I don't feel is even advanced trader friendly, because it's a very easy pattern to get caught off guard. Once again, the purpose of sharing this pattern was to put contrast in, to show you what a difficult pattern might look like versus a more complex pattern. And that doesn't necessarily mean the cup and handle is going to be all the more accurate. So it is something that is out there, and historically speaking, the results of a bullish outcome when you see this formation is higher than 50%, and as such, it is worth sharing. But this is not going to be my top recommendation. But once again, it shows you why some of the other patterns are as wonderful as I'm saying they are, because when you compare them to what else is out there, you realize that they are representing some of the easier stuff to find. And as we move along, now we have something called support and resistance, which I sure hope everyone is aware of support and resistance, at least in what the word means. How you identify support and resistance is a skill that never gets old. Identifying support and resistance and the proficiency in it is something you're going to be doing. It doesn't matter how long you trade. Okay, I've been playing with support and resistance. I've been using support and resistance, and I've been perfecting my support and resistance game for well over 15 years. It's not something you ever throw away, so it's always valuable. But the concept here with support and resistance, just for those of you that are fresh out the gate, support's always going to be an area that supports price. It's an area in the market where we have a wall of buyers or an absence of sellers, either or those scenarios. It's going to be our basic economy 101. It's a situation where the value becomes appealing enough for people to buy, but not appealing enough for people to sell, and as such, price doesn't want to go any lower. Resistance is the opposite of that. That was the sloppiest straight line I've ever seen, but it is going to be an area where there's an absence of buyers or sellers an absence of buyers, or the buyers are just unwilling to buy beyond that point. Now, this represents areas in the market where if other people have seen this in the past, they may be inclined to do these things again in the future. We see support and resistance recycle over and over and over again, and a lot of times areas of support then become areas of resistance, as you can see over here, and vice versa. This is an example of a resistance area becoming support. We found resistance on 1, 2 occasions, then we broke through it, and then after breaking through it, the market came back down to see what was going to go on here, see if we'd fall back below. But now that area that was previously resistance is now functioning as support, giving the market an opportunity to go up. That's just the general concept of support and resistance. We are actually going to look at that on some live charts. So let's go ahead and flip on over to some live charts, and let's take a look at some support and resistance and possibly see some patterns along the way as well. So let's see what we've got here, and I'll switch my little tool here to white. We got a little bit better of a contrast for you. So looking at the Finamark platform right now, let's shift around and see what we can see. Well, right off the bat, before we do anything else, let's use the drawing tools because it's going to be, not that. Let's do the drawing tools because it's going to be a lot smoother than my hand. And I'm going to draw a gold line here, right where we have some support and resistance going on in the market. Just to analyze this, just to show you how easy sometimes it is to find this stuff, guys. So what we have here is a situation where the market was initially traveling upwards. It was, ooh, that's a green line. That's interesting. It was traveling upwards. So we were going up, and then all of a sudden, boom, we hit some resistance right here. The resistance was a point where the sellers said, hey, we're ready to sell around this location, and they temporarily overpowered the buyers, but the buyers already had a temporary area of support right here. I don't know if you can see it, and they bounced off of it and rammed their shoulder right back into the sellers and broke this with reckless abandon. This is an example of a clean break. This is a candle that has undeniably broken through, traded above, and closed above the area in question. So when we go back to a lot of the examples that we were talking about with the price action patterns, this is what I'm talking about when I look for my trigger point, when I look for my candle, when I look for the break above the wedge, when I look for the break above the head and shoulders neckline. This is what I want to see, okay? And if I see this, this is going to be good enough for me to get in for a long opportunity, right? So, but without further ado, let's keep moving. So we have an area that was previously resistance, okay, right here. Then it was broken, all right? And once it was broken, what did the market do once it substantiated which side of it wanted to trade on? So we had this tumultuous period where the buyers and the sellers were kind of fighting back and forth. But once the buyers got up again, or got up above this level again, we then started seeing the market treating this as an area of support. It got close, and then price started shifting away from it, almost like a, like two ends of a magnet. So what did we end up with over here? More support. Once again, this was initially resistance, and the market continued to find support around this area for a while. This was going on for quite some time until we had a clean break. What does a clean break look like? A candle that leaves no shadow of a doubt. It is definitively doing what it is trying to do. It is moving through price and closing through price. And it stands out, just like our candle over here on the left did. This candle over here on the right stands out. Now that we've flipped through that, what happens when we shift to the right? Well, as we shift to the right, we notice that the market began finding a little bit of resistance as it got close, but it's not close enough to really call that a test of it. But the market did start showing a little bit of a hesitation to stay away from this over here on the underside. Once again, this was an area that was initially resistance, then support, then potentially resistance yet again. But the market came back up to this area. And when we see a candle close like this directly on our level in question, that's an indication that we want to wait one more candle. Why is it an indication that we want to wait one more candle? Because it's not a clear indication that our potential level is valid and holding at the moment. So what do we wait one more candle for? Well, this one more candle comes and we get a clear break candle. We get a candle that is well above, closing above, and we have a strong bullish candle above. So at this point, the battle has been handed over to the buyers. And we should expect to see some support shown if we do return to it. And that is exactly what we were given. The market came back down. We found some support. The market worked its way back up, came back down, found some support. And then we came down with a big break and a slop all the way through. At this point, we have an area in the market that has been used multiple times. And even though every single time hasn't been a successful rejection, if you will. If we go back just right now, let's zoom her out. If we go back and we look at the amount of times that the market rejected off of this versus the times that the market, I'll do a horizontal line for the times that it didn't. There we go. We have a bunch of situations where the market was more inclined to reject off of it, obviously, than to fall through it. So if we just roughly look at this, if you look at the vertical lines versus the horizontal lines, the concept here is it's not going to be 100% of the time that we expect that rejection. We do expect price to pass through, but the idea is, what are we doing? We're bending the odds in our favor when we're paying attention to things like this, and we use these as logical reasons to justify an entry into the market. We're already keeping if we're keeping ourselves on the right side of the trend, as well as on the logic of support and resistance, when support and resistance is likely to hold more than it's not, historically speaking, once again, then we're going to give ourselves an opportunity to find trades that are more likely than not, even without any other intelligent thought, we're going to give ourselves trades that have us in favor of winning them more so than a blind choice. And that's where it all begins. That's where it all begins for every trader. It begins with trying to get yourself over blind choice, trying to get yourself over the coin flip. And just doing simple things like this already gets you over the coin flip. Then when you get better at controlling your risk to reward ratios, this information plus proper control of risk to reward ratios sometimes is all it takes to progressively gain profit, as long as you're disciplined and you stick to it. The issue that I find with most traders is not that they don't understand what we talked about today. It's not that they don't understand price action patterns or can't comprehend a head and shoulders. It's that they don't have the discipline or the patience to wait for the patterns or the support and resistance, or to line up with the trend in order to get those 2, 3, 4 layer confirmation deep justifications for looking to buy into the market. That's usually the case. Most traders that are having difficulty because they're over trading. Most traders are having difficulty because they don't have the patience to wait for common sense. They have the gut instinct, which is really, in trading, a lot of times your gut is more of a seductress. It's more of a devil in a lot of ways, because usually a gut instinct is something that we can't rationalize with words as to why we want to do it. And if we can't rationalize logically why we want to buy or why we want to sell, well, chances are there probably isn't a logical reason to buy or sell. And if you go on that gut instinct and then you happen to be right, that's even worse, because then you start to reward yourself. You start to boost that ego and you're like, oh, I must be a fortune teller. I got it right. Well, the sad truth is, folks, I don't think any of us here, well, maybe you are. I'm not a fortune teller. So all I can do is share what has worked for my career and what has worked for the traders that I've mentored. I've seen traders do well after mentoring, and I've seen traders fail after mentoring. It's how it works. Trading is not for everybody. Trading is for those that want to win, that have a desire to win, and their desire to win is stronger than their desire to take shortcuts. It's stronger than their desire to to lose patience and to go off gut instincts and to try to be a lottery car winner. The lottery's always there, regardless if you live anywhere in the United States anyway. There's a million ways you can buy a lottery ticket every single day or week. And if that's what you're interested in, by all means, go see if you can win that Powerball. But for those of you that are, desiring something systematic, something that you can do and feel proud of instead of something that you did and were lucky and are in some strange denial, this is how you do it. You do it with technical analysis. You do it with a combination of technical analysis and fundamental analysis, depending on the time frame of what you're trading, and whether you're swing trading, whether you're position trading, whether you're scalping. You do it progressively. You do it slowly. You find a way to get to 51%, and then you find a way to get to 52%. You don't change the strategy every single time that it doesn't go your favor. Instead, you understand why it didn't go your favor, and then you can systematically change one thing at a time, measure the results, see if it increased your accuracy rating, your results, or see if it decreased them. If it increased them, you keep it, and then you can begin the process of changing one more thing. See if it goes up further from there, or if it goes down. That is the process, and that is the truth to being a trader. The truth isn't just buying some secret holy grail technical analysis indicator that's probably based on fractals, that it's putting a plot on your screen where to buy and where to sell. No. The truth is just understanding the simple concepts of how the economy works. It's why are things rising? Why are things falling? And how does the psychology of traders fit into that mixture? How does it fit into that paradigm? Support and resistance is a way of illustrating that paradigm. It's a way of telling the story of where people are interested in buying and where people are interested in buying again in the future because they saw people buy again in the past, or where are orders waiting to be filled because they didn't get filled the first time. That is the concepts that we're talking about here. That is the concept behind all price action patterns. And I'm a huge fan and a huge proponent for price action patterns because it is what ultimately I was able to break through and become a profitable trader with. And I spent a long time not being one. And then I found a great interest in analyzing and potentially helping others that I see a lot of myself in. I'm not the most intelligent guy in the world, but I found a way to make it work, and I find value in feeling that others can potentially gain from what I have to share. And for that reason, that's why I am here today, and I hope to see you guys at some point or another at Earn2Trade, and I will end up bringing it back over to Terry, and as well as answering any of your questions at this point, if anyone has any questions about price action, folks. But never forsake the simple things. Just because you understand something doesn't mean that you're too good for it. That is the best piece of advice that I could probably leave you guys with, those of you that are here today. But I will give it back to you, Terry, if you are ready to rock and roll.
Okay, there we go. Let's see. It says many index futures seem to follow the index almost tick for tick, which is an advantage for many stocks, which are separately traded. Does this analysis work better for non-tracked futures like metals, ags, etc., rather than index futures?
It applies to both. Now, the asset to which you're analyzing, it could be stocks, it could be a tracked futures, it could be, it doesn't matter what it is that you're looking at. The concepts of the economic principles that we're talking about absolutely apply to anything that you can trade, because if you can trade it, you are taking a portion, you're taking part in the market, which in turn validates that self-fulfilling prophecy concept. So the short answer is it can absolutely be applied to everything. However, I strongly encourage comparing results that you achieve with more than one asset. That way you can get an idea of where which market seems to suit your particular results better.
There's a question that says, can you find any of those patterns on the graph? I couldn't. Not exactly.
Can you find any? Absolutely. All those patterns are from a graph. Let's see if we can, let me see if I can flip back over here. Let's see if we can find anything. Let's see if we can find a quick head and shoulders, shall we? So Let's see. The truth is, folks, you're going to see slightly sloppier variations of the patterns that we're talking about on a daily basis. You're not going to see it always as perfectly clean as a textbook image, and that's obviously should be common sense. But when you just start looking at stuff like this, what do we have in a situation like this where we're starting to get this general concept form? This is a sloppy head and shoulders, what we have going on here. It's a very sloppy head and shoulders, but just right off the bat, without doing any flipping around, we have an area where price was traveling downwards. We have a shoulder, then we had price travel upwards, then we had price come down, and then we traveled upwards yet again. Now it's extremely sloppy, and the concept here is that this is a reversal pattern, and the way that we would trade this is by looking for a break in the neckline, and because there isn't a really clearly defined neckline, this isn't an example of a pattern that you would be able to trade just right off of the bat in this exact scenario. But with the information that you understand about the economics of why the market is anticipated to reverse, like we talked about, what does it symbolize when you're seeing this type of a movement where you have a support that leads to a lower support, that leads to a higher support that's closer to the initial here is absolutely something that you can take advantage of. And the thing to take advantage of in this type of a situation that should stick out right in your mind is if we fell from the resistance is what allowed us to fall to this point. We should be looking for a return to this resistance or a break of the head. And in that situation, unless we're going to fall below the head, we can break above. And if we break above, we have a future area of support. All of these patterns happen all the time. Now, when I say all the time, I don't mean every second of every single day, but they are occurring, and it's good to just continuously scan, and we can keep going back. Okay, for example, you have a bit of a, here we go. What do we have here? You have a situation here where you've got yourself a bit of a sideways rectangle. What do you have? You have a support where it led to a resistance, which led to a support, which led to a resistance, and we had a break, which led to the direction of the overall prevailing trend in that scenario. And that's what we had. We had a nice little drop off here. These patterns occur over and over and over again. They're all over the place. And if you can't find them, you need to just keep playing around with your charts until you become a little bit more familiar with them, and they'll start sticking out. I can keep going backwards and keep throwing them off, but I feel like this is, we'll just end up into another hour of me talking about patterns, and I don't want to bore anybody or take any more of anyone's time, but let's see if we can find one more. Let's see if we can find a really, really pretty one here. Let's see. What I can tell you I will not find, almost certainly, most likely, would be a cup and a handle. That would be the closest version of one right there, but let's see. Let's flip over to an hourly and see if we get a nice little view here. All right. Oh. You can just go on to the next question, Terry, by the way. I'll see if I can pop one up while you're going through it.
All right, he says, what kind of situations would you recommend aggressive entries versus passive entries? A limit order versus a stop order?
As far as if you're price action trading and you're doing it based on the patterns that we talked about, which is what I imagine that's referencing, just because here we are, most of the situations are going to be aggressive entries in the sense that they're mostly going to be market orders. Now, people get afraid of market orders because they don't like the idea of slippage, which is totally understandable. But the truth is, if we're waiting for a candle to close, that means in nature, we can't just simply set a limit order above. If I have, where's my drawing tool? If I have, say we have a head and shoulders, which once again, it's just my favorite. It's why I constantly go back to it. So say we've got a situation like this and we're looking for the break and the candle is to close up here. If the market spikes above this and ticks a limit order, it'll fill the limit order before actually closing above, and you may have a fail of the break of the neckline, which could in turn lead to other bearish momentum. So if you have that, a limit order is not going to be your friend, which is why I like to wait for confirmation of some sort. And the confirmation that I like to wait for is this guy right here. It's the closed candle above the pattern break, then look for the market order to buy.
Okay. Does this analysis work on any interval chart, 5 minute, 10 minute?
Absolutely. Now, everything that we talked about is going to apply to every asset, every time frame. But the thing to remember, folks, especially if you're a newer trader, as you go down the time frame, I'm looking at even at an hourly chart. That is a pretty low time frame right now. 15 minutes, even lower. Right? As we go down, what do you start to notice with the chart? You start to notice more volatility, which means the market and your trades are more susceptible to what's called market noise. And if you're more susceptible to those hiccups and bumps in the market, that is going to be another issue with the limit order ideology there, with trying to set them with a anticipated break location. But that is just something to be aware of. Accuracy of lower time frame charts is almost always, when applied the same strategy to a higher time frame chart, almost always lower on the, I said that in a weird way, but so let me just clarify that. So the lower time frame charts are almost always lower accuracy you'll find in your analysis than your higher time frame chart analysis. And that is just across the board. If you're one of the, honestly, I've never met anybody that doesn't apply to, so I'm just going to leave it there. I've never met anybody that can't apply their strategy to a higher time frame chart and find a slight increase in accuracy, even if it's small.
Okay. Also, I think to add to that is, if you're looking at one time frame and you're trading on a pattern that time frame, don't get confused by signals on a smaller time frame. I think a lot of people, they'll be trading like an hour and then they'll see something that confirms on the 15-minute, and
Absolutely.
we'll try to trade based off that when it's outside the time frame of what they actually were originally looking at.
Absolutely. Thank you. Yeah, absolutely. Thank you very much. Yeah. So what he just brought up is crucial, and that's just a blunder on my part for not adding that in. But if you find a head and shoulders on a 15-minute chart and you trade it like it's an hourly trade, that's not logical. You're not gonna have a good time. If you trade on an hourly chart for a 15-minute trade, which means you set your stop loss, you find a head and shoulders on an hourly chart or a 4-hour chart, and there's a beautiful head and shoulders forming. You just watch the neckline finally break, and you're going in for your long, and you set your stop loss to say 5 points, and you're trading the ES because you're trading off a 4-hour chart. Well, 5 points might be enough to pull out a stop loss, that might be a logical stop loss for a shorter time frame where price isn't moving as much on the shorter time frame, on the lower time frame charts. But that's not going to suit you well on the hourly, and the results and the expectation might hold true for that hourly head and shoulders or that 4-hour head and shoulders that you were looking at, but you might get stopped out of it with keeping your stop too tight. So everything needs to be taken into consideration. If you're trading a higher time frame, expect the moves to be swing, and that goes both ways, in the positive way too. Our gains should be larger, our trades should be bigger, which means our stop losses should be bigger on the higher time frame. So everything scales. If you find it on the time frame, trade it on the time frame that you found it on.
He says, I'm a beginner trader trading the MES. What is the best time or tick frame to use?
If you are a beginner, I would avoid ticks at the moment. I would avoid tick charts in general, is what he's talking about, folks. I would avoid tick charts until you feel you can play around with them, but a good one to play around with 1200, 1600, but I wouldn't go really any lower than that. It's going to start to get pretty darn small on you, and it's going to get kind of weird looking. So I wouldn't really drop too far below 1200 or 1600 really, if you're going to play with ticks. But I would strongly encourage paying attention to 30-minute and hourly charts. Those are very active while still being more beginner friendly than, say, a 5 or a 15. 5 or 15 is great for your experience while you're using a demo account. 5 or 15 is excellent in that. Excuse me. 5 or 15 is excellent in the regard that you're going to get a lot of action in a relatively short amount of time, but it can absolutely bite you if you don't have the experience, because once again, your accuracy on a 5-minute chart 100% should be lower than your accuracy on an hourly chart. And if it's not, the chances are you just don't have a large enough sample size yet. But that's just, the noise and the volatility are higher.
Okay, I think that is the last question. I'll give him another minute or so to slide one in. I guess let's go to that last slide to leave it for the end of the video.
You got it. But as far as we go at Earn2Trade, guys, I'm not always the most comfortable in front of large groups of people. It's something I'm always working on, and it's ironic because I am an educational presenter and mentor, but that's usually a one-on-one basis. I appreciate you guys bearing with me in case I stutter once again, but we're pretty proud, and I'm pretty proud of what we do over at Earn2Trade, and I really do strongly recommend that you guys come check us out, and I mean that in an earnest sense, not even a marketing sense. I'm not gaining any commission or anything from this. I just like the idea of providing people an opportunity to not spend their life savings learning to trade, because chances are, if you can't pass at Earn2Trade, if you can't pass and trade with someone else's money, chances are you're probably not going to be able to do it on your own with your own money, right? That's just logical, right? And for the entire month, I think we have 40% off. I don't know if it's just for you guys. You can always message our live support on the site, and that's all us too. We don't use like a third party company in India or something like that. That's just with people that are unrelated to the product. But obviously nothing against India at all. But I think it's 40% off the $25,000 Gauntlet Mini this month. I think that's what we've got going on. Especially if you say that I said it, you'll get it. So that's just a little tidbit of goody good goods for you.
All right. Thank you for the webinar and the information, and for spending some time with us this evening.
Thank you very much, Terry. Thank you very much, Futures.io, and I will see you guys in the next one. Have a good rest of your